So now, welcome back, ladies and gentlemen. I have heard that you have had engaged discussions. I hope you enjoyed the breakout sessions. That's very good. We will now talk about MiFID II, trends, challenges, and opportunities. And I have here Mark Alexandrian, professor for accounting and finance. And the floor is yours.
Fantastic.
Good to have you here. Thank you.
Thank you very much, and thank you all for being here. Despite this is probably one of the last sessions today. I just want to start my talk by thanking, first of all, Lorna and her wonderful team for organizing, the big part of this research survey that we carried out, or have been carrying out for the past 3 months. Without her support, that wouldn't be possible. And by way of introduction, this is a joint work, still at an early stage. This is a joint work with my co-author, Professor Kenneth Lee from Loughborough University. And as the title suggests, we're looking at the impact of the MiFID II, the regulation that I'm sure all of you, or those who have at least been in the profession for more than 6 years, are very well aware of. And so we're looking at, essentially what we've already done, we have carried out a survey and in-depth interview-based analysis, perceptive study of investor relations in the UK as to how MiFID II, in their view, has changed their practice, the ecosystem of their engagement with the sell side, with the buy side, as well as their own and all activities. But we were kind of confined to the UK case, and so we thought, well, we need to find out how things are happening across Europe. And so with Lorna's help, we've organized a survey of the Swiss investor relations officers. And I'm sure there are people in this audience who have actually responded and completed some of the questions that I'm going to cover through today. So what we found in the UK was general that after MiFID II, because of the impact MiFID II had on the displacement of the sell side from the triangle of the interaction between the corporate and the buy side, the investor engagement with the buy side has increased incredibly, and also the role of the IROs has gone up internally and externally. And we thought, look, let's go and now see whether we are observing the same sort of situation elsewhere in Europe, and so Switzerland is our sample now that we're looking at. So just maybe a couple of sort of slides first as to what has been the overall impact of MiFID II on the perception of IROs here in Switzerland and the UK about the relative importance of IRO and IR function for your companies. So if you look across these charts, you will see that the perceived importance of IR function after MiFID II has gone up. More than or close to 50% of IROs have reported, both in the UK and Switzerland, that now we are perceived by our own C-suites as being more important, being more influential within our companies, and our role has increased. And that also sort of is mirrored in the amount of time now and the workload that IROs are having. So that has really gone through the roof. So compared to what IROs have been doing or how much work they've been carrying out before MiFID II, to what's happening right now after MiFID II, IROs are much busier. So I'm going now to dive into some of the effects that have contributed to this change in IROs' role and importance, as well as the level of busyness of IROs. So the first thing we've looked at the impact of MiFID II on analyst work. I'm pretty sure many of you have your views and have experienced changes in your interaction engagement with the sell side, as well as have views about the changes in the quality and coverage of sell side analysts on your company. But what we are finding here is the first two charts. If you look at them, there is an interesting comparison between the UK and Switzerland. So in the UK, what we found is that the coverage of analysts did change, but that change was sort of bifurcated between the large cap companies and smaller companies. So FTSE 100 versus FTSE 250, for instance. So the coverage of larger companies has gone down quite significantly, whereas the analyst coverage of smaller companies, FTSE 250 in our case, hasn't sort of gone down. So about half of our respondents said, yes, we've experienced a drop in coverage, and the other half said, look, no, actually our coverage has gone up. So if we look across what's happened in Switzerland, we do see overall that both across the large and small size companies, there has been a reduction in analyst coverage. So this is a sort of a point of difference that we're observing here. The next question that we were interested in, okay, well, now we see that the coverage has changed for the better or worse, but what do you think? Is this a good thing for your company or the bad thing? So in the UK, in this chart on the right-hand side, what we saw is that overall IROs were not dissatisfied with this drop in coverage, and we attribute it to the overall research glut that was there in the UK market pre-MiFID. So MiFID, in a way, kind of calibrated, sort of took out those redundant analysts and redundant research that wasn't necessarily adding value. Whereas in Switzerland, what we see, okay, still, a sizable minority of IROs are finding that, you're satisfied with the coverage, but there is also a sizable minority of IROs who are commenting or saying that, look, we would quite like more coverage. So that also suggests that probably in Switzerland to start with, prior to MiFID, the coverage wasn't perceived as being more than enough. It was probably just about right. In terms of research quality, there is quite a consistent pattern both in the UK and Switzerland. Also, when you bifurcate it by large versus smaller companies, we see that there is a massive reduction in the perception of IROs in terms of the quality of the research that analysts produce. And that also relates to the quantity, or in other words, the frequency of the research notes that analysts produced on the regular basis for the companies they cover. And again, this pattern is consistent across the countries as well as the size groups of companies. The one important question is there, okay, well, if the analyst coverage has gone down in general, and if the quality has gone down, what about the level of knowledge of those remaining analysts about the company? And what we saw is, as we can see here, is a massive reduction, quite a sizable reduction in the perceived knowledgeability of the sell-side analyst about the companies that they are covering. Okay, and this could be attributed to one particular phenomenon, post MiFID, because of the sort of unbundling of the research and trade execution fees. What's happened? The budgets for the research have gone down, and a lot of the more expensive, highly rated analysts either exited the field or they migrated and joined the buy side, and the buy side internalized a lot of the sell side, previously produced sell side research internally. And so what's left in the market essentially is what we call juniorization of analysts. So analysts increasingly became more junior because they're cheaper, and also they were asked to produce more research, cover more stocks, and that resulted in perceived lower sort of a quality of the research they produce. So this explains some of the findings that we have here. One other interesting aspect is that the access of companies, i.e. IROs, to analyst research that cover you guys has also gone down. So you now have, according to the data, right? Not necessarily your particular company, but it looks like IROs now have less access or less knowledge about what the sell-side analysts are telling the outer market, the buy side, about you, right? There is less visibility on the part of IROs about the messaging that sell-side is sort of channeling into the buy side, to the investment community. Now, let's briefly touch on what's happened on the buy side. So also a couple of questions about the effects on IROs' relationships with investors, with the buy side. So what we see here in these graphs is that the direct engagement of IROs has shot through the roof, as you can see in this middle bar here. And this is persistent both across the UK and Switzerland. So there is much more direct engagement and interaction between IROs and your investors, the buy side, compared to how things stood before MiFID II. And this is quite nicely explained by the fact that now sell-side analysts are essentially no longer there to the extent they used to be, and therefore that direct messaging and direct engagement with the buy side is much more prevalent now. And this direct engagement is a sort of a two-way process. It's not just that you are receiving more queries, more inbound inquiries from the buy side, but also you are engaged in much more direct targeting of your investors, prospective investors, or talking with existing investors, bypassing this analyst channel. So there is a direct engagement. So from the perspective of IROs, this might be good news, because now you know your investors much better. You speak with them. You can, channel or craft your corporate story and deliver it directly to your investors. But if you take a step back and look at the overall market for information and the fairness of market, you would see a reduction of publicly available information, that is sell-side research. And therefore, arguably, yes, for companies or some companies, that might be good news, that you're connecting directly with investors. But for the broader ecosystem and the broader, public market for publicly available information, that's not necessarily a good news. And with this increased direct engagement with investors also comes the amount of time that now you are having to spend with investors, with the buy side, to educate them, right? Answer their queries, bring them on board with your, the corporate story, to educate about the company's strategy, etc. And we have throughout the day had a number of wonderful presentations about how important that is to craft your story and use the right means to deliver that story to investors for their decision making. So to conclude with a couple of other slides, what we ask at the end of the survey is we ask the IROs to give us one or two most salient kind of effects that came on the back of MiFID 2. And we asked that same question, obviously, both of the UK investor relations as well as the investor relations officers in Switzerland. And what we got is quite a consistent picture in terms of the main themes or topics, albeit some topics were more prevalent in Switzerland, in Swiss responses, others were more prevalent in the UK. But if I could maybe just look at the Swiss responses, so what has been, as perceived by IROs, the most important change after MiFID 2 in this space has been the increase in direct engagement or targeting of investors. That theme is also present in the UK, but not necessarily the most sort of salient one. And we could see that there are maybe one or two themes that are present amongst the Swiss respondents, but not so in the UK. If you sort of look at this greenish sort of column of data here, in Switzerland, it was particularly strongly mentioned that the research coverage of smaller companies has gone down, right? See, this is not what we observed in the UK, but in Switzerland, this is quite prevalent, that after MiFID 2, smaller companies have actually lost out in terms of the coverage and the availability of research. And finally, we asked the question, again, directed at the IROs, as to what is it that the regulators, if we could influence the regulators, what is it that they should do, right? I was quite surprised by the answer, and we had to do some sort of textual analysis because this was an open-ended question rather than multiple choice question. But essentially, looking at the first block, that's the most prevalent theme, and I could summarize this long text there in 2 words. The perception of Swiss IROs in its prevalence could be expressed in 2 words: scrap it. Scrap it. Or some people actually quite use this word, scrap it. Some said ditch it, which is obviously the same thing. But even the longer answers, like 2-3 line answers, could be reduced to that very meaning. So we want to go back to the pre-MiFID era, where research was bundled, where we knew what analysts were telling about us to the buy side. We were better covered. The research quality has higher, etc. Another interesting theme is that if scrapping it is not a solution, then at least in the Swiss context, the regulators should develop and design some sort of mechanism that would allow better coverage for smaller companies by designing sort of pay structures that would enable that process. And final point that was raised by a few, that we need a bit of harmonization. It's not good in a globally connected market where, in the UK or more generally in Europe, you have to abide by MiFID II, whereas you don't have to in Asia or in the United States. So it's a quite complex regulatory settings, and a lot of IROs would value some sort of harmonization of the reporting regime, regulatory regime. So that's the end of my presentation. Thank you again for your attention. Thanks for listening. Just briefly to mention that we're also involved in a couple of other research projects involving IR professionals, and one is on the IR and artificial intelligence. Okay, so we are hoping to do another survey on that particular topic, as well as more in-depth research interviews. So taking this opportunity, I would like to beg your cooperation, because we will probably be contacting some of you to engage with us on this research project, or if you feel some sort of emotional attachment to the topic of AI and the future of work, please do get in touch with us. Okay, thank you very much. Oh, that's me again. Yeah. Nice.
Thank you very much, Mark. We talked a lot about AI and IR this morning, so this is going to be interesting what your service will bring out, Mark. Thank you very much. Now, the grande finale, so to say. We have Karsten Junius with us today. He's Chief Economist at Bank J. Safra Sarasin. And he is Head of Economic and Strategic Research, and thus also responsible for asset class forecasts. Previously, he was Senior Economist at the International Monetary Fund. We are happy to have you here, as I said, for the finale. Thank you very much.
Great. Thank you very much. Thanks for the invitation. I am actually very happy to be here and present our kind of annual outlook for the first time to an external audience. And I was asked to talk about economic and geopolitical dynamics in 2025, and that fits very, very well to our main message that we would like to give to you, to our investors, and to our colleagues. And that is that policy choices will matter quite a bit this year and shape financial markets. Last year, this year we actually had all these bigger elections in most of the democratic countries. Now we will have new leaders in place that come up with new ideas, and they are more important than ever. And we already saw this in financial markets right after the election of Donald Trump, where suddenly equity prices jumped significantly, where bond yields were fluctuating with all these news that we are getting every day, where the dollar is up and where gold prices have been falling since the election. I will talk about the US a bit later, why that is the case and where we are heading in financial markets. Let me state mention five topics that politically wise shape the current environment and that we shouldn't forget. So on a broader scheme, we should be aware that we are in a period of geo-economic fragmentation. So what does this mean? Well, basically, old trade patterns, old investment patterns do not hold any further. And you see this nicely on the left-hand side of this chart over here, where on the red line, you see the US imports from China, a share that is declining sharply since a few years. You see other shares therefore increasing significantly. Those of other Asian countries where production has shifted to. and also the one of Mexico, where also a lot of companies are now locating if they want to be competitive, but also want to export to the US. On the right-hand side, we see another pattern, that of capital flows. We used to be in a period or in a world where capital flew everywhere, no matter whether it's distant or far away. Well, this has become much different. Now capital flows are going to countries that are less distant. So we are regrouping. That's a lot of change. Connected to that is topic number 2, that China is actually playing a much more important role in many other countries, not only in Europe, not only in the US. They are gaining dominant influence in the so-called global south. And that is important over here for us in Europe as well. Because if China is becoming so dominant in all these African, South American countries, it will be much more difficult for us to compete with our products in those same markets. And we see this reshifting of trade patterns in China here on the left-hand side. The major surplus that China is actually producing, the trade surplus, is not with developed countries anymore. It is with the emerging market world. And on the left-hand side, you see also shifting on investment patterns. China isn't that focused anymore on Europe and the US. China is focused now on all the other third countries that partly are commodity rich, they are partly growing much faster than we do in Europe. So let's talk about Europe. Topic number 3 is that unfortunately we are falling far behind. And here what I show is the relative per capita income of the Euro area and the UK versus the US. So basically the chart shows that currently European countries are only earning 2/3 of what people would earn in the US. Well, there are always level differences, and we also have level differences with Switzerland to the US. Our Swiss level line would be a bit further up, but also for Switzerland, the trend that we observed in Europe in the last 10 years holds. Relative to the US, our per capita income has been growing not as much as that of the American households. Topic number 4, also that is related with European misery. That is that the fiscal constraints that governments have are becoming tighter and tighter. And we just have 2 governments that failed out of fiscal considerations. The German one and most probably the French one as well. And that is a material change. Because remember, just a few years ago in the pandemic, governments were able to spend like crazy. With the effect that in the pandemic, initially, debt to GDP ratios increased. And then something positive set in. There was the great inflation. And inflation has one advantage. It increases nominal GDP. Nominal GDP. So, and if you have debt relatively constant and increase your nominal GDP, well, your debt to GDP ratio falls, as happened in all countries. Well, the disadvantage of inflation is that after some point, interest rates also increase. And that is what is happening now. And you see that on the right-hand side of this slide, that interest rate expenses in percent of GDP, which have been declining for more or less 20 years in a row. Well, they're about to turn, and they will increase much further in the next few years, reducing fiscal space that governments have. And this will make policy making much more difficult than it used to be. Well, and then last topic, we should prepare ourselves for a global trade war initiated by the coming US president. And this has the potential of huge wealth disadvantages. By the way, also for the US, and this is why I'm showing this particular slide, where we lump together all those policy proposals that Donald Trump has. Some are positive for growth. That is actually those in the gray bars or gray fields. That's the tax cuts. Yes, lower taxes usually helpful for growth. Most of the others actually would deduct from the growth baseline that exists, like tariffs, like financial conditions, like lower immigration. Obviously, if you have fewer people, well, then it's getting more difficult to produce, and wages usually increase much more. So there is something that is potentially there, while we don't know when it's coming. We don't know who will be targeted first, but I come to that a bit later. Let's have a look now at our individual countries and where we believe the continents are heading to. As always, we start with the US. For financial markets, the dominant country. And the good news is that despite years of very favorable developments, this is not changing right now. We still believe that there will be a soft landing of the US economy where growth rates are coming down slowly without falling in a recession. And that is combined with inflationary pressure that is also coming down, as you see on the right-hand side. I'm often getting asked, hey, what is actually the soft landing? There's no landing. You know, the US economy is booming. Well, in a way, that is true. But where can we see the soft landing? That is in the labor market, where just 1.5 years ago, there were 2 vacancies per 1 unemployed person. And that has changed. As you see in that slide, the ratio is now more or less 1 to 1. So the economy has been cooling. There has been a soft landing. And it's a very nice and fantastic development for financial markets that all this happened without a major crash in financial markets. So where are we heading now after the election? Well, it was a remarkable election, I have to say. An election that made a lot of people happy. We see this in consumer confidence, something that is a good indicator for private consumption. And one nice little detail of this consumer confidence is that people are also asked whether they favor the Democratic or the Republican Party. And what I always find fascinating is that your happiness, your well-being, your assessment of economic developments completely depends whether you are leaning towards one or the other party. We see this over here. So in the Obama years, well, Democratic Party supporters were on average much happier than Republican Party supporters. And that changed within a few weeks after the election. Again with Trump, again with Biden, and here we see that change coming as well. That Republicans are getting much happier, and Democrats are disappointed or assess their own future, the future of the country and financial markets and all that stuff is in a more pessimistic way. So what I want to show, since we had such a decisive victory of the Republicans, there are more people happier than unhappier. And that should lead to some animal spirits in the economy, that should lead to some investment spending, that should lead to more household consumption, at least for a while. Then the other thing that we also observe is that new orders are picking up in the US again. And today, we had a long discussion about this, whether this would be the big re-acceleration of the world economy. And here I say, yes, orders are picking up. And that is good signal, well, for all of you that are owning US stocks, as it's an indication that the economic dynamic is not falling apart in the next few months. But there's a disadvantage to all this. New orders are also picking up because people are preparing for a trade war, which basically means that they are buying all their intermediate inputs that they need now before Trump is actually being able to impose tariffs on other countries, as with higher tariffs, well, imported inputs would become more expensive. So we see this pick up in inventories. And one thing is clear: if you have enough inventories, at some point you stop ordering them. Basically, that means, in my view, that we will still have a good period ahead of us, maybe a month, maybe two, where equity markets and financial markets are fully supported by the economic dynamic, maybe a bit longer. But at some point, we should be careful what is going on. Let's move to the elephant in the room when it comes to forecasting, that is the trade war. And honestly, we have no clue how it would look like. We don't really know when it's happening, if it's only all negotiating. But we can have a look at countries that would be most effective. And well, the first look that we should have is actually where are the most of the imports of the US economy coming from? And here we see the main trading partners. Naturally, that's always your neighbors. That's no difference in the US as it's in Switzerland. You trade most with your neighbors. And then you trade mostly with those countries that are industrial superpowers like China, Japan, and Germany. Switzerland is also here, but we shouldn't worry too much. We are just a small country in the eyes of the US administration. Well, second thing then, we know that Trump doesn't like bilateral trade deficits. So we should have a look at those countries that have these high trade deficits with the US. And here, well, similar faces. We have China, Mexico, Vietnam, Germany, and Ireland, Japan. So basically the same bunch of countries. Still, Switzerland is only a very small bilateral trade difference. So are we safe over here? Ladies and gentlemen, unfortunately, we are not. As I want to show with this slide over here, even though we are very, very small in the eyes of the US, we are extremely open in general and have a very high share of trade to GDP. So any tariff that Trump would impose in general on all countries would hurt us more than other countries. Let's move over to the euro area. Honestly, there haven't been many good news coming from Europe lately, and that is nicely summarized with this low point in GDP growth that we see over here. What is better is that inflation has been coming down. And we see this, and it's clear we are close to the 2% line in our forecast for 2025. So I believe that the ECB has plenty potential to cut its policy rate. They should do so next Thursday, and they should cut 4 more times to a level of 2% in June. That, in turn, should help the European economy such that we believe that we will see somewhat stronger growth in the second half of next year. Only in the second half, however. So the slides are on Switzerland already. So, let me go back to that. So what about Switzerland? Well, everything is a bit better over here. Growth dynamic is better, and we are further ahead in the adjustment process in this cycle, which we can nicely see that in unemployment rates, in insolvency rates, that have both been picking up, while unemployment in the euro area is still at rock bottom, at record low levels. We still have to deal with this environment, and I don't expect much for the export sector in the coming quarters. I also don't expect much of investment spending in an environment where most of our markets are more or less stagnating. Companies don't invest, and looking back, companies did reduce their investment spending in 5 of the last 6 quarters. So for me, that means that we also need significantly lower interest rates in Switzerland than we have right now. And timing of this conference is very fortunate, as we had our investment committee, the monthly one today, and we also officially reduced our policy expectations for the Swiss National Bank, expecting now a cut of 50 basis points next Thursday and a reduction of policy rates down to 0 by June. Well, this is possible because the inflation risks are on the downside, as I wanted to show with this chart on the right-hand side very clearly. Inflation will fall to very low levels next year. Actually, it is already at very low levels if we forget these rent increases that we have seen. Ex-rent inflation, as it was published this morning, is just 0.1% compared to last year. And maybe even a slide on that. I don't. Doesn't matter. You got the point. No, good there's no slide, because actually I couldn't have updated it. So ex-rent inflation is 0.1%. That is nothing. And it clearly shows the risks that we have. It is not high inflation as most other countries. It's low inflation. And we all know that electricity prices are falling by 10% in January. And it's also almost certain that rents will increase as the reference rate will most likely be adjusted downward in March, which means that rents could fall by July or so. All this is leading to downward pressure on the inflation rate, and the one right thing of the SNB is to cut interest rates accordingly. Last thing, China, also because it fits the policy choices story so nicely. The Chinese economy is not doing well. We still have all these structural problems in the real estate sector. And what they need in order to prop up growth would also be decisive policy action. However, we believe that they are just delivering enough policy support to achieve their growth target or growth between 4 to 5%. So, well, our purpose in our company, why we do all these forecasts, well, because we want to know what is going on in financial markets, and therefore, let me spend a few words on that topic. Well, with the booming US economy, there is less of a reason to slash interest rates. With tariffs coming that potentially narrow down the trade deficit, well, there's hundreds of reasons why the US dollar should remain strong. And that is exactly what we are forecasting for the next few months. Even though I know a lot of is priced in markets, it would be odd to see interest rates falling significantly in Switzerland and the euro area while they remain at quite high level in the US without a strengthening of the US dollar. So let's be prepared for still expensive holidays in the US if you really want to go there. The other thing is gold. Well, gold is usually falling if interest rates in the US remain high and the US dollar is strong. But still, we are seeing shifts here, namely that since the US governments use the dollar as a weapon, foreign policy weapon, a lot of countries are shifting their foreign reserves out of the US dollar. And I absolutely believe that this is going to continue. Very clearly. Why having FX reserves for the rainy days if you actually cannot use them if you're affected, if you're feeling that rain? And that is what happened to Russia, what happened to Iran, that might happen to many other countries that for whatever reason might not be favored by the next administration. So the structural trend towards higher gold prices is something that I could imagine will continue. Then let's talk about tax cuts. Well, there's this big hope that tax cuts lift corporate earnings. And well, that is true. We have seen this, what happened in 2017. Well, tax reduction increased corporate earnings, and particularly those of smaller companies that have a higher earnings have more earnings in the domestic economy than globally. So there is something we see a push from. Then on the other hand, we also had the trade war in 2017-18, which did cost earnings growth. So two opposing factors. We believe, well, actually, we don't know how this trade war unfolds. Last time, the tax cuts were more important than the trade war on aggregate. We hope this will be the case again, but in the end, it really depends on policies. So, and then let's come finally to the equity markets. I'm getting asked again and again whether US stock prices can continue outperforming the rest of the world. Well, for the time being, yes, and especially for the next 2 months, I would probably still be optimistic. As we are seeing, as I mentioned, these good news kicking in. The strong US economy, while we have miserable news and stagnating economies in the euro area and China. Still, I think we should look at this chart very, very closely. it more or less shows that the US economy is extremely expensively valued. And we should be aware of that. We have kind of peak optimism when it comes to the US dollar, when it comes to the US stock market. And at some point, when economic data doesn't continue to surprise on the upside anymore, maybe because all US companies have all their inventories at extreme levels already. Well, then I think we should become a bit more careful when it comes to the US stock market. So with that, let me sum up. Basic story for next year is policy choices will matter. And we should analyze them closely when it comes to what actual policies are implemented in the US, but also in Germany with their debt brake, in France with, I have no clue what they are going to do. All these things will matter. For the time being, I believe the US economy is growing nicely and will deliver good returns, such that in financial markets we continue to like risk assets like equities as well will benefit from solid US growth. And that also means that US dollar remains strong for a while. And third, that interest rates into Europe and in the US will diverge for a while. With that, thank you very much for your attention. And I believe we have some time for questions also.
Some seconds. Thank you. But you did not mention crypto. And I was wondering why, because this is now in the media, it's a huge topic, and people say, yeah, because Donald Trump is a fan of cryptocurrencies. Why did you not mention crypto?
Because I don't have any.
We were
so
too late.
Embarrassing.
Yeah, we were too late, right?
Yeah, far too late.
Yeah.
Always avoid that topic as much as I can, because it doesn't make me happy.
And now it's too late, you think? But what could crypto like Bitcoin really play as a role now in the economy?
Well, in the black economy, a lot of good things. If you want to shift money without anyone seeing it, I absolutely see that
my
use
criminal
case,
money.
But as long as I'm paid for standing here and talking and advising our portfolio managers, it has little value for me.
I understand.
For me safe. So I wouldn't invest in crypto very clearly. It's not paying any dividends, not paying any interest rate. It has high transaction fees. And so far, I can still travel in all these countries there where I want to travel. But other people have different preferences and needs. Okay.
Are we going to face a minus interest, eine Minuszins phase again in Switzerland?
Well, it's not our forecast. So our forecast very clearly is we are going down to 0% and we are staying there until end 2026.
But that's what we thought last time as well, that we don't go underneath.
Yeah, we don't go. So that is, but the risks are clear. Yeah, if we are forecasting 0%, well, we only need minor external shocks to inflation. Maybe some political turmoils here or there that lead to further appreciation of the Swiss franc. And then inflation rates could fall into negative territory. And then I would believe negative interest rates would be appropriate as well. Mm-hmm. But no one likes them. Mm-hmm. Yeah, neither do we, I guess, nor the National Bank. They doesn't like them either, so they will avoid them if possible. I could imagine if we really get an exchange rate shock and have zero interest rates, well, their instrument of choice would rather be FX intervention at that stage. Mm. But, yeah.
I don't know if you're going to answer my next question, but I try. You can maybe give a diplomatic answer. You know that everybody knows here that Switzerland and the EU are working on a framework, and it could be that they get something together at the end of this year. It looks like I had an interview with Bundesrat Beat Jans last week about this. And if we see the economy of Europe, the EU, Europe, why should, that's my question, Switzerland be so keen to get closer to Europe, or are we falling and going down with the EU if we get closer with a framework? What is your opinion there?
Well, very, very clear. We, as a small open economy, we are extremely vulnerable to external shocks. And if the EU has one strength, then it's not the euro. It's the big common market. And that is an extremely strong thing. That is, by the way, the thing that that is even extremely in the US. Why the US? People often ask, hey, why they are richer? Yeah? Well, let's think about it. They have a huge market, not only for goods and goods, as we mainly have in Europe, where Switzerland participates fully, but they have it for services as well. Meaning that all their technological innovations, the Facebooks, all the AI stuff, whatever, you name it, they have a huge market for that and can reap these scale economies that we cannot. Mm-hmm. Being able to participate in a huge market would be an incredible benefit for Switzerland that it shouldn't give up. So the closer we are getting to this common market, the better it is for Switzerland. That is very clear, and I just hope that within Europe we have more trade liberalization, that more sectors are actually participating in this common market than they do so far.
So maybe they need to invite Elon Musk to reduce regulation in Brussels. Or an Elon Musk.
Well, I hope that that is actually an interesting point, because one of the strengths that we have in Europe, that we are setting the regulation for a lot of other countries as well. And but for my personal preference, it's true that we also have too much.
Thank you very much, Carsten Junius.
Thank you
very much. And for a short sum up at the end of this conference, I would like to welcome Vera Güttinger again. Give her a warm applause. She was together with Lorna. I don't see Lorna. Where is she? All there in the back. She was organizing this event, and I heard that it was a wonderful event so far. And now you have the final words, and I think we also asked the last question to our audience. So please take again your iPhone or whatever, a smartphone, sorry. And we ask you the question, you will see it here, or otherwise, what was your highlight today? What was your highlight or takeaway of the conference? The person who wanted to meet Vera, done. Check, so good. Networking, good. That was the term in the morning. Networking again. Economic update, good for having you here. Although I'm not sure if I should be a bit depressed about the future. Maybe a glass of wine would help, huh? So
yes. We can have that afterwards.
So still the networking, huh? That's really interesting.
Yeah, so we should do just a networking conference next year, maybe.
Yeah, just a nice get-together, just go directly to the apéro, huh? We start in the morning with the apéro. So
with a short economic update, and then we go directly.
And then we go and get drunk
part.
all together, like the Lemminge, huh? Oh, yeah, exactly. So, what's your conclusion on this?
Yes, exactly that. So for the next year, we will take these takeaways and highlights. Of course, you can already mark your calendars. We will have the next Investor Relations Conference on the 27th of November in 2025. So please mark it. And what I wanted to mention and forgot, maybe you already saw on your name tag, there is a bottle opener, and it's at the same time it's a USB stick. So we did an investor survey on ESG topics together with Quantifier, and you will find the report of this survey on this USB stick. So please appreciate it, because Charlie spent his whole Sunday to upload the reports. And outside, please take a beer. So that you can drink on your way to the Klaushög, where we hopefully meet again, or take it home and drink it on your way home, or wherever you would like. So please don't forget it. And I also want to thank you all that you came here. I hope that you learned a lot, that you could network a lot, that you liked also the breakout sessions. And yeah, so thank you. And also thank you for the organizational team, for Lorna, for the Aya Club, for Alicia, for my team, Michael, Christian, for everyone. So quite happy to have you, and made this a success. And yeah, also for all the speakers that we had here, and of course the participants. Thank you.
Thank you very much. Thank you.